Harubo, bienvenido. Hi, Young, and welcome to episode 59 of the ESG show. Now, in investment circles, they often say that the time to buy is when others are selling. So sentiment is a funny thing. Ha 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 ha. Ideas go in and out of fashion, and markets often get caught up in the next big thing. And sometimes we have what the former Fed chair Akan Greenspan called irrational exuberance. I think these periods of irrational exuberance come more often than is commonly realised, but I also think that the backlash is often overdone too. And I have some news. Climate change is not something we can wish away. And whatever sentiment says about the need for climate-friendly policies, facts don't change. ESG has been coming under a lot of criticism of late, some of it justified, some of it builds upon a misunderstanding of what ESG is. That's why I say we are seeing irrational pessimism. The backlash may ultimately prove as useful as a backlash against the idea that the sun rises in the morning. King Canute, an English king back in the 900 AD period, supposedly told the tide to stop, setting aside the possibility that the king was actually making a point to fawning nobles. Just because you command nature to perform in a certain way, that doesn't mean it will obey. And I guess you could say the same about human nature as well. This morning, I was reading about the crash in the Tesla share price. We can overstate the scale of this crash. The fact is, Tesla shares are up tenfold from 5 years ago. But if the recent trend in Tesla shares continues, then it has a problem. And maybe this illustrates the need to court public opinion. If consumers don't like the way a company or its boss behaves, sales can suffer. I also read this morning that BP is doing a reset. 25 years or so ago, under the leadership of Lord Brown, it rebranded itself as Beyond Petroleum. Now it seems to be saying back to petroleum. But the oil companies are simultaneously shifting away from renewables to dishing out massive dividends. What does that mean, I wonder? Anyway, before we meet today's guests, I want to tell you about an event we have planned. Our next episode will be episode 60, and we will be broadcasting it on April the 9th. So we won't be doing anything for 6 weeks, and that's because we're planning something big, an all-day extravaganza with trapeze artists and lion tamers and fire swallowers. Oh no, wait a moment. Oh no, sorry. The trapeze artists, lion tamers and fire swallowers can't make it, but there will be something even better. 50 amazing guests. And together we will follow the theme ESG Strikes Back. If you're interested in taking part, either as a guest partner or sponsor, please get in touch. But anyway, that's enough from me. Let's bring on today's guests. And I thought we would go straight in there with a question about ESG investments. How are they holding up right now? Bill.
Michael, thanks for having me on. I would say it's a difficult question to answer because an ESG investment is not, it's not like you're buying one stock, you're actually building portfolios. And so in general, ESG is doing fine in that regard. I think that the bigger issue is that there was, to your earlier point, some irrational exuberance around ESG investing 3-4 years ago in the US, which led to a lot of unauthentic product, a lot of unauthentic actors, maybe a lot of unreasonable expectations. And that has certainly faced some backlash. And I would say that assets are not growing in the space that the way they were 3 years ago. There has been sort of a reconciliation, and a lot of players have left the market, and the ones that are authentic are doubling down and doing very well. But I guess that would be my answer. I think ESG is going to be fine because investors want it and need it, and that's true all over the world.
Okay, thank you for that. And same question to you, Elisa. How's ESG investment holding up right now?
Great, thank you, and echo my thanks for being on the show today. So, I agree with Bill, and I take it more from a perspective looking at the fixed income markets, because that's what our impact investing strategy focuses on. But I agree. I think there's, within our specific opportunity sets, there's still a lot of opportunities for investment, a lot of opportunity for growth. And when it comes down to it, the thesis of what ESG is all about, as Bill said, it's not going away. It's a lot of different things, but it's something that adds an additional risk management layer to investing. And again, that's, if you look at the historical thesis and long-term thesis, that's not going away.
Okay, and Chris, same question for you.
Thanks, Michael. But there's a few different ways of looking at this. I mean, clearly, 2024 was a difficult year, I think, for a lot of sustainable investments. And Morningstar, for example, in their most recent, their Q4 2024 Global Sustainable Fund Flows report, pointed out that actually there had been a bit of an upsurge in Q4, but that didn't really fully offset the overall difficult picture, in which global ESG funds had recorded their lowest inflows since 2018, whilst the rest of the market had done pretty well. So clearly, it had been a bad year if you take that data point. But to offset that, one could perhaps consider the performance of one of the biggest ESG focused investors in the world, which would be the sovereign wealth fund of Norway, run by Norges Bank Investment Management, and they produced their results statement earlier this week for 2024, and they returned their 13.1%, which was a record high across 2024. And Norges are very well known to apply ESG kind of principles to how they invest. So it's clear that it is possible to make a pretty handsome return whilst investing sustainably.
Okay, thank you, Chris. Now I thought it'd be fun if we could play a game of hot and cold. So I'll ask you a question and you say hot or cold. Hot means you're big on this, you're up on this, and cold means you don't, and you've got roughly 30 seconds to give me an approximate answer. And I thought I'd start with you, Bill. But before I do, I thought I'd introduce you properly. So, well, I would if I only pulled up the correct profile. Bill Davis is a managing partner and portfolio manager at Stance Capital. He formed the firm to bring to market investment portfolios that mitigate material, environmental, social, and governance risks, while at the same time allowing investors to align their portfolios with their belief systems. Bill is a frequent guest on CNBC, Bloomberg, and a variety of traditional and new media outlets focus on the fiduciary and cultural aspects of value-aligned investing. And indeed, Bill's been on the ESG show before as well. He serves on the boards of the Ceres and Children's Environmental Literacy Foundation and is an engagement lead within Climate Action 100. Does that say plus? Yes, 100 plus, a global collaboration of asset owners and managers representing $68 trillion of investable assets, all leaning into the world's largest carbon emitters. Bill has taught environmental entrepreneurship at Columbia University Center for Environmental Research and Conservation, and guest lectured at Harvard College, Harvard Business Schools, MIT Sloan, and Vanderbilt University. Great to have you back, Bill, after I think you were on about just over a year ago before. Actually, I think it's more than that. I think it's about 14 months ago you were last on the show. And I want to ask you, my first question for you is a little bit similar to the first one. So you've partly answered it, but I just think it'd be nice just to put it in one sort of succinct morsel as such, which is there a future in ESG investing?
Yeah, of course. There's absolutely a future. I mean, one way to look at it is that investing is either passive or active. And to the extent that investing is active, there is frequently a values alignment tilt going on. I would argue that even anti-ESG portfolios are basically ESG. It's just a completely different set of values. And so, if anything, I think that there is more values alignment being packed into investment decision making and portfolio planning than maybe ever before. And I'll just stop right there.
Thank you, Bill. And now I'm going to introduce you properly, Elisa. Let's just hope that we've got the right screen this time. Oh, how about that? Got it right first time. Elisa Greenspan is the CEO and President of Community Capital Management, LLC. And as the Chief Executive Officer and President, Elisa provides strategic leadership and oversees all aspects of the firm's operations, including risk management, compliance, and client service. A recognized authority in impact industry, Elisa is a frequent speaker on the subject and has been instrumental in developing advanced impact metrics and customized reporting solutions at CCM. She worked closely with clients to integrate their impact and investment goals, ensuring alignment and measurable results. Elisa received her BSM in finance from Tulane. Have I pronounced that correctly? Is it Tulane?
Correct.
Tulane University, and an MBA from the University of Miami, a word I can pronounce. She is a CFA charter holder and holds FINRA licenses series 6, 7, 24, 26, and 63. So I've got, sorry about that. Playing a game of click on the wrong screens for a moment there. Elisa, same question for you that I asked to Bill, which is a sort of reiteration of what I've asked so far. It'd be nice to just put it in a succinct morsel. Is there a future in ESG investing?
Yes, there's definitely a future in ESG investing. Otherwise, I don't think you'd have us on the show, right? But yes, of course there is. So by way of sort of context, Community Capital, we just celebrated 25 years of impactful fixed income investing, staying true to our mission of delivering strong financial results while making a positive societal impact for our clients. Since our inception 25 years ago, we've invested approximately $17 billion in fixed income securities whose positive use of proceeds have some sort of measurable, quantifiable impact to society. And this is on behalf of our clients throughout the United States, where we're domestic to the U.S. So in our vein, most investors, regardless of type of investor, are looking to enhance the community in which they live. And in that regard, why wouldn't they do so via their investment portfolios if they're able to earn similar returns and similar risk profiles?
Thank you, Elisa. Now I'm going to call Chris back on. And assuming I can click on the right buttons, I'll introduce you first. We just had a comment from Makama. And Makama, I think he appreciated me saying welcome in Swahili this morning. So good to have you on. Chris. Chris is the CEO and president. That's not Chris. Thought it was too good to be true, getting it right first time with Elisa. Chris Hall is the co-founder and editor of ESG Investor. Chris Hall, a UK's publication launched in 2020 to help asset owners globally to develop and implement sustainable investment strategies. Chris has many years' experience as a reporter, editor, and freelance writer, covering the wholesale financial markets from security trading to asset management to corporate treasury. As a freelancer from 2014, Chris combined commission from a range of leading B2B finance sector titles with regular corporate copywriting engagements from major financial institutions, market infrastructure operations, and technology providers. For this, he was managing editor of The Trade for 8 years, overseeing a suite of publications serving the trading desks of asset managers globally. He was previously the editor of Automated Trader, a quarterly journal focused on the use of automated and algorithmic trading techniques in the financial markets. Chris has extensive experience in journalism, research, and PR, and has written and contributed to a number of books on finance industry issues. So, Chris, same question for you. Is there a future in ESG investing?
Well, I think from reading out our comparative resumes, it's quite clear that Alyssa and Bill are far more qualified to answer this question than I am. But I could turn it back to say, is there a future without ESG investing? I think that's possibly open to another way of framing the debate. But I think that the reason why there is a future in ESG investing is because of the vast amount of evidence that ignoring environmental, social, and governance risks and the fact that they haven't been present on financial statements and balance sheets up until relatively recently. The losses to investors and the kind of build-up in systemic risks that has arisen through companies being able to externalize those kind of negative factors. The damage to society, the losses to investors through the kind of previous approach really kind of underlines why it's important to integrate those ESG factors and in order to kind of build enterprise value for the long term, which is kind of good for investors, good for businesses, and good for the societies in which they operate.
Thank you, Chris. I was wondering if we could just quickly touch on the issue of Tesla, which I referred to in the intro just now. I think it is quite interesting. Let's not overrate this. If you'd invested in Tesla 5 years ago, you'd be a very happy bunny right now. But the fact is that the Tesla shares have fallen very, very sharply over the last few weeks. And it appears the reason for that has got something to do with the attitude of consumers, especially in Europe, but not exclusively in Europe, who feel that Tesla no longer represents the values that they agree with. And I wonder whether there's a lesson here that relates to ESG. Does this show that the behavior of a company can affect the profit and can affect the share price? What are your thoughts about that? Who fancies going first on that one? I mean, we discussed this earlier, Bill. Do you want to kick off that discussion?
Yeah, and just to pick up on what we were discussing earlier, Chris, you made the point that, it seems very reasonable that it is the case that if a company acts in a manner that essentially pisses off all of its clients and they no longer want to buy the product, that's a kind of a bad thing in a causal relationship. I think in the case of Tesla, that has been the case, certainly in the US and in Europe. But there's also other things that are the case that are more fundamental, like can they deliver, in fact, on autonomous taxis, which is a promise that they've made for years, and now nobody thinks that they can do it. But look, when you've got a company that is very badly governed and creates a lot of headline risk from an ESG standpoint, that it can be very, very damaging to investor performance. So bad governance equals performance risk, and the same as environmental exposure can equal performance risk. So and Tesla is, to be very clear, a very, very badly governed company. And so I am not surprised that its shares have fallen out of favor. And but we're also in a kind of like a wacky constitutional crisis kind of a world in the US right now. And it's not clear, what impact that's going to have on all of this as well. But yeah, it's certainly an interesting case study.
I like your description of a wacky crisis. It reminds me of wacky races. I wonder if who's stick dastardly in this episode at the moment. Elisa, any thoughts about Tesla?
No, I mean, it's not stock that we follow, since it's not the the markets that we tend to invest in. But I do agree I do know from my years in the capital markets that the markets don't lie. And if there is, share price, there's a reason why that the share price is falling. So I'll leave it at that.
Okay. And Chris, any comments before we move on?
Sure. Well, I think it's interesting kind of competitive environment where you have one of the biggest Chinese manufacturers, BYD, offering for free some of the kind of smarter software that you would have to pay extra for if you went to Tesla or one of its other rivals. And they're making a very, very kind of strong push right now. At the same time, Tesla, as well as their kind of autonomous taxi difficulties, they have been slow in rolling out new products, and I think that the competitive landscape is getting tougher. I think I read that there was something like 50 new electric vehicles or models coming out on the European kind of market over the next 12 months. So the pace is hot, and I think if you're not concentrating on that core business, then that trouble can lead from that.
All right, thank you for that, Chris. Okay, another question for you all. Given the sort of the backlash against the industry, what I refer to as irrational pessimism, is now a good time to buy, do you think? Any volunteers coming on that one?
Well, I can start off by mentioning that one organisation that has bought recently is the asset manager Brookfield, who bought 1.7 billion, or rather paid 1.7 billion for the UK National Grid's onshore renewables business in the US. And Brookfield is quite a canny investor. It has investments across the energy sector, but has put a lot into kind of clean energy. And this comes at a time when, as you suggest, Michael, that things were not looking particularly good for renewable energy providers, at least on the surface, in the US, with Donald Trump signing executive orders to implement his mantra of drill, baby, drill, and certainly pausing offshore wind development, which is a particular issue for him. And so the stocks of a certain number of firms involved in renewables certainly did go down. But if Brookfield is buying, then perhaps that does say something else.
Okay, thank you for that. And Elisa and Bill, do you want to come in on that question, or?
Sure. I mean, we're buy and hold investors. We're always looking for opportunities, within our opportunity set of the bond market that look for good opportunities to buy. That being said, we've seen an increase in issuance in some of the sectors that we are investing in. We've also seen a decline in issuance as some corporations are holding back their issuance of so-called green bonds or other bonds that might have a positive use of proceeds, but might be deemed right now as too woke. So that being said, but yeah, we do see buying opportunities, and it's something that we continually look for as we look to meet the objectives of our clients' portfolios, which is mission alignment and securities that are financing something with a positive impact.
Okay, thank you for that. So the last few weeks, we've seen a very different attitude in Europe towards the idea of spending money on defence. I don't know. Is Stephen Fry well known in America? Elisa and Bill, do you know who Stephen Fry is? Or is he one of those people whose fame hasn't crossed the border? I don't know. Stephen Fry is very famous in the UK. He's a comedian, but he's just I think he's known as a national treasure, really. And I saw an interview with him recently. He said, well, he's always considered himself to be an old lefty, but all of a sudden he finds himself supporting the idea of spending more money on defence. And it suddenly, there's this kind of very new attitude towards defence spending has emerged very, very suddenly in Europe, certainly in the UK. And typically, I think defence spending wasn't necessarily considered as a great ESG tactic. So, is defence spending the new woke? How do you tackle? How does that fit in with ESG? Do you think? Anyone got any thoughts about that?
Well, so keep in mind that there is no definition of ESG, and that, of course, is one of the biggest problems with the space. But I would say that in general, at least on the equity side, most ESG investors, at least in the US, tend to be fossil-free and weapons-free, and other things free, like generally tobacco. I mean, those are sort of the three most common exclusions. And so I would say that, but I would also say that, like, and we are as well, right? And we basically build portfolios that are weapons free. The fact that the US this may be a good market for defense companies isn't going to affect anything we do, because you could say the same thing about fossil fuels. Every once in a while, it's really good to be a fossil fuel investor, but the reality is, like, at least in the US over the last 10 years, if you were fossil free, the S&P 500 ex fossil fuels outperformed the S&P 500, including fossil fuels. And so generally speaking, we have no problem excluding a sector of the economy if its values don't align with the profile that our clients are looking for, and we're not going to second guess that decision.
Okay, thank you, Bill. Chris and Lisa, do either of you want to come in on that one, or are you ready to move on to the next thing? Speak now, or hold both piece.
Go ahead, Chris.
Okay, thanks, Lisa. Yeah, I mean, obviously, Bill is right that exclusion screens have been for weapons has been an absolute kind of core of ESG investing. But obviously, it's a kind of a self-imposed one. There's nothing necessarily to kind of stop firms changing their mind if they align themselves with the kind of rebrand of investing in weapons as kind of defending democracy. So I think that there will be pressure from policymakers to encourage them to do so. I mean, we've noticed in Europe on a number of occasions, ministers, UK ministers, Dutch ministers have kind of made comments suggesting that they would like their pensions industries to invest, and obviously those are long-term investors who very often take an ESG lens to their investing. They've been criticised for not investing enough in the European defence sector. There will be a greater pressure, I think, in the future. There may be clarifications in the recent or the current and ongoing Sustainable Finance Omnibus initiative, which is streamlining and clarifying some of the sustainable finance rules in Europe that may kind of go in that direction as well. And also the new commission has promised with 100 days of it taking office, which was late last year, that they would produce a new white paper on the future of the European defence industry that would cover investment from the private sector. That report is due probably by the middle of March, so we may see that pressure being brought to bear on asset owners.
Okay, thank you, Chris. Alicia, have you got anything to add before we move on?
Yeah, the only thing that I would add, I mean, this is certainly not my wheelhouse. We do not invest in defense stocks or the bond issuers, any corporations that are involved with defense. The only where we would get involved on behalf of our clients is if, to the extent that there's bonds issued that can help actually bring capital to those areas that are affected by war and other issues. So where the the bonds are helping to rebuild a certain area. So, for example, last year we purchased a bond that was issued in the U.S. by the Council of Europe, one of the banks, but they issued it in the U.S. and it was the use of proceeds for helping to rebuild parts of Ukraine. So that's where we get in on the flip side of it.
Okay, all right, thanks, Alicia. So I was wondering, can we drill a little bit deeper into this idea of an ESG backlash? Chris, you were talking to me recently about threats of legal action on antitrust groups. I think it was you, Chris. I hope I haven't got you mixed up. I think it was you. Can you just go into a little bit more detail about that?
Sure. Well, I mean, this has been really kind of going on for at least a couple of years now. In that this has been largely, I guess, populist wing of the Republican Party, both within Congress and the kind of state attorneys general have in a number of ways put pressure on some of the kind of coalitions in the finance sector that have been set up in order to coordinate action towards net zero in the sector. So I'm sure we remember that that GFANZ was set up at COP21 in Glasgow. GFANZ being the Glasgow Financial Alliance for Net Zero, and that was an umbrella body that had a number of different kind of sub-alliances in the insurance sector, asset management sector, banking sector. Now, because of the kind of pressure and that has been in terms of hearings, of letters, of threats of legal action, those and also the kind of change in the kind of occupant of the White House now, that most of those alliances have kind of have seen basically they've either collapsed entirely or their US membership has largely kind of deserted themselves under the pressure, largely that pressure has come in the form of claims that this activity, this kind of collaborative activity, in order to coordinate how they operate, how they reduce the emissions in their portfolios, somehow it is against the kind of existing antitrust laws in the US. Now, I've yet to see a legal opinion that agrees with that and suggests that would actually hold up in court. However, and I think the issue really is what are the motivations of the organisations that are doing the collaborating? That seems to be the kind of critical factor in whether an antitrust suit would hold or not. But essentially the banks can't afford the risk, the time, the money that would be involved in defending themselves properly in a court against those antitrust kind of accusations. So those have been very powerful. They haven't been the only tool, but they've been pretty powerful in essentially encouraging US financial institutions to go their own way on their kind of climate commitments, rather than collaborating, which would potentially have more sway, more force.
Okay, thank you, Chris. Oops. I'm not doing very well with my killing up of people today. Bill and Elisa, before we move on, have you got anything to add to the issue of anti-index funds? On
the issue of antitrust in the U.S., I'm very involved in Climate Action 100 Plus, which is one of the, in addition to the Net Zero Alliance, is sort of one of the major groups that the anti-ESG crowd has gone after. I would make a couple of observations. First is, I'm not sure that this was a forest fire that they realized they were starting, but this entire movement was born out of funding by the oil and gas industry in the US to a couple of politically motivated associations in two states, Texas and West Virginia, around this idea of anti-ESG. And it developed such a strong following that they kind of turned it into a national movement. I think I'm with Chris, the idea that a nonprofit collective where there is no agreed upon joint action other than to engage with companies, and I'm speaking specifically about Climate Action 100, the idea that could be could represent cartel-like behavior and subject to U.S. antitrust laws is, laughable, actually. If it wasn't, the fact that we're witnessing an environment where, in fact, you could, in fact, see that being brought credibly forward in certain court systems in the US. But and what I would say is that it did certainly scare away some primarily US-based managers. But interestingly, and I co-lead an engagement within Climate Action 100. And interestingly, we have made up the lost members in our own engagement that were US-based with more European investors who are even bigger than the ones that we lost. And I would also say that there's one other side to this equation, and that is the companies that we're engaging with. And in particular, the company that I'm engaged with, they understand that climate risk is real, and they view it as an opportunity, right? They view it as an opportunity to sell more equipment, to expand market share, and all of these other things. So even though there's this politically motivated backlash, and even though there is occasionally pushback by companies, in general, I think most companies are moving in the direction that the investors are asking them to go in, which is to be more ambitious around decarbonization, and more transparent around things like political contributions and those kinds of behaviors. So I think that the system is still going to work. It's just slightly different because of the players are shifting around a little bit.
Okay, thanks for that. Bill, you were telling me about an article on Bloomberg. Maybe she's illegal now. This involves a bill you were telling me about in which a pilot brought a class action complaint arguing that BlackRock does ESG, that ESG is not in the best interest of investors, and that American Airlines violated its fiduciary duty to its beneficiaries by letting BlackRock do ESG. According to the judge, the evidence and expert testimony revealed that an investment strategy assumes an ESG label when it is aimed at, in whole or in part, bringing about certain types of societal change. He continued, ESG investing is a strategy that considers or pursues a non-pecuniary interest as an end in itself, rather than as a means to some financial end. Judge Reed O'Connor ruled that BlackRock, the company selected to manage most of the airline's $26 billion retirement plan, harmed the financial interests of plan participants through its ESG activism that dictated that delivering financial performance was no longer enough. According to the author of the Bloomberg article, Levine, he said the result is apparently that investors are not allowed to consider risks if those risks are politically disfavored. Can you just expand a little bit more about this, Bill? I mean, what's all this about? Thoughts?
So to me, the two most interesting things about the American Airlines lawsuit, the first is that American Airlines didn't actually offer ESG investment options in their 401k plan. I want to repeat that. There were no ESG investment options in the 401k plan. And American has a reputation for resisting them over a long period of time. So what the judge actually found was not a breach of fiduciary duty because they weren't offering ESG plans to begin with, but this whole case is about the fact that BlackRock, in exercising its proxy voting, had voted for a couple of dissident Exxon directors. And ultimately, in theory, if American Airlines, and that caused the stock price to go down by pennies, like not a lot of money, for a very short period of time. So basically, the lawsuit is basically that somehow or other American Airlines 401k plan participants were disadvantaged by the fact that Exxon's share prices went down because of the proxy voting practices of the outside investment firm. So that's kind of like one crazy thing. Like nobody was really affected by this. The second thing that's crazy is that the judge also referenced cartel-like behavior, almost as if in coordination with the Republicans in Congress who have been alleging cartel-like behavior. And so it's not clear to me whether there is any penalty associated with what happened. I don't think a financial penalty has been levied against American Airlines at this point in time. It's pretty hard to imagine what that would be. I mean, BlackRock basically ran an index fund. And so to the extent that anybody was harmed, anybody who owned that index was harmed. But again, it was for a very, very short period of time. And of course, the stock price recovered. So it's just kind of another example of, I think, the anti-ESG movement doing everything it can to make this hard for people who are kind of practicing what Alyssa and I and Chris are trying to practice.
Okay. All right. And Elisa, you're saying about the reason why it is sustainable is because it accounts for extra risks, which is perhaps something which I think ties in with Bill's point there, really, is that it's not anti-profit. She isn't anti-profit. It's not anti-business. It's about taking into account additional risks. Can you sort of expand on that point a little bit?
Sure. So, right, exactly. I mean, I think that, ESG, impact investing, socially responsible investing, whatever you want to call it, over the years and how it's evolved, has certainly evolved into something that is really just looking for a greater means of transparency. So what are the risks that a company or a issuer might have that you would not, that it might be in a normal course of doing business, but it's a way that an investor can assess the I don't want to say the true risks, but like the underlying risks of a company. So whether it's the within their workforce or their board governance, or what's the company doing to help offset climate change, even within their in their ecosystem or their crop company. So it's just can be used, and it is used as a measure of risk management, really. And when you look back at what's the definition of impact investing, it's it's making investments to help create beneficial social or environmental effects while also generating financial gains. So it's not, again, going back to our fiduciary duty, we're not it's not looking to misalign the fiduciary duty at all. And if anything, it's an increase in the fiduciary duty rule, basically.
Okay, thanks. So Bonnie Lind. So for some reason, I don't know why Bonnie's name doesn't come up here, but Bonnie has been a guest on the show before and will be a guest on the show in the future. And she says ESG is defined negative screens, i.e. divestment and weapons, tobacco, etc., are ethical, specific screens. You can have ESG internal controls and measures on weapons manufacturers, i.e. labour, health, safety of the manufacturers. The controversy is the double materiality external effect of weapons. And Bonnie also said that she totally agrees with what Bill was saying about American Airlines. This case was wild and will be debated by the ESG folks for a long while yet. Okay, so Chris, you were also talking about this sort of tension between short and long term, which I think ties in slightly with what Lisa was saying about the risk element of ESG. Can you sort of expand a little bit about this tension?
Yeah, well, I think this is a kind of a tension that has always existed in different forms of investment, and indeed just financial decision making of any kind, really. Which is, what is your time horizon? And we write primarily for asset owners, and they're interested in effectively intergenerational wealth transfer. They're looking whether they are, sometimes they can be endowments or foundations, so they're looking decades into the future. But so are insurance firms and pension firms. They've got liabilities well in the future, and so they want to make sure that that they can make good on those liabilities, but also they have an interest in the future of the planet and society in decades time. Whereas their kind of core kind of partners in the execution of their investment strategies, asset managers, very typically, with some exceptions, but large asset managers aren't necessarily kind of incentivized to look beyond maybe a much shorter time horizon. And the politicians that are putting the policies in place that to influence corporates in how they kind of manage their kind of carbon footprints or their impact on society, that they have a similarly kind of short kind of time horizon regarding their investment, their decisions on their priorities. So I think that as some of the kind of systemic risks that we're all facing become kind of more apparent and have kind of more serious implications, and I think that tension between how one manages one's kind of short-term and long-term priorities inevitably gets a little more tense. And I think it's important for all of us in whichever roles we have to try and kind of resolve those tensions, because we know full well that if we can put off those decisions, whether they're to kind of address biodiversity loss or income inequalities in society, then the cost of doing so later is much higher than doing so now.
Okay, all right. Chris, I've also got a note here, and I'm wondering whether I'm written it down right. You're talking about anti-index funds. Is that correct? Have I got that right?
Well,
Can you expand on that? And what's that got to do with ESG investing?
Well, I think the point here is that, as with the example that Bill raised with American Airlines, that there is I think there's a kind of there's an anti-elitist, there's an anti-incumbent element to a number of the kind of criticisms and accusations against ESG and sustainable investing. And I think that BlackRock has taken the full brunt of this in terms of the amount of times it's been taken to court by various state AGs. But Vanguard and to a lesser extent State Street, but Vanguard have been hit by this as well. And I think all those large index funds have a lot of power and have a lot of influence because they own a sizable chunk of many companies, many sectors, and I think that's one of the reasons the power that they have and how they utilize that has come under scrutiny. And I think there was an element of where there's an overlap between kind of anti-ESG sentiment and some of the kind of pointing the finger at the large index funds and examining how they use their influence. I think an example of this would be a court action that was led by the state AG of Texas, whereby effectively accused those three big index funds of pressurizing the or raising the price of coal through their engagement with the large coal manufacturers in the US in a way that was detrimental to the interests of the kind of typical hard-pressed American family. And so I think there's an example of there being more than one element at play in some of these cases against that are part of the kind of anti-ESG backlash.
So I just got three more questions for each of you. Well, three questions. I'm going to ask you each the same three questions. But before we move on, does Elisa and Bill, do you want to pick up on anything that's been said over the last few minutes?
I want to add one thing, which is that, interestingly, yes, BlackRock is under pressure from certain state AGs in the US, but I read a couple of days ago that now there's a bunch of European asset owners that are leading a movement to divest from BlackRock because they were too namby-pamby in the US, specifically around the issue of caving on things like proxy voting and agreeing to basically, take ESG funds away. So I think, and this gets back to what I said at the very beginning, and I think that there is going to be this is sustainable investing, whatever it gets called, is not going away. Zero chance of that. However, I think that there is going to be a recalibration of who's really doing it intentionally and who isn't. And I think it's going to result in some shifting of funds. Now, that's a wishful thing for me to say as a boutique asset manager when I'm talking about BlackRock. But I do think that we are going to see some movement away from BlackRock, much in the same way that, there's been movement away from Tesla. So I think it all stands to reason that this could happen.
Interesting. I like your technical terminology there, namby-pamby. That'd be an interesting form of investing, I think, a namby-pamby investing. We move on. Do you have anything to mention, Elisa? Elisa, yes. Sorry.
Alyssa, no. I agree with what's been said. Nothing more to add. Thanks.
Okay, so let's cut to the chase then. The theme is irrational pessimism. Is this irrational pessimism? So, do you think there is irrational pessimism relating to ESG? I'll ask the same question to all of you. And Elisa, do you want to go first on that?
Sure, even though it's not my namesake, unfortunately, for the Akan Greenspan of the irrational exuberance days. But I kind of grappled with this. I don't think that. I think there's a lot of irrational things happening right now. I don't know if pessimism is the right word as it relates to ESG investing. I think there's more of a sort of leveling out of the playing field, and kind of as Bill mentioned, we'll sort of see the tried and true players who have a consistent strategy, have a history of doing this. It's part of their DNA. It's not just something that they added to, a label of their mutual fund or investment product. So I think that there's just going to be a leveling of the playing field. And in the end, those left standing are those that are, sort of tried and true to their investment process and philosophy. And for the investors as well. And I don't think that there's still an increase in demand for this type of, and I don't want to say it's just a type of investing strategy, because I think it's just interwoven into what investing is. Okay.
All right. I think this is quite an interesting question here. It's a question to the experts, which is you guys. Do you think that markets are strongly overvalued because true sustainability risks are hardly priced in, meaning there are amazing opportunities for sustainable investors? Which I think it does tie in with the irrational pessimism question in a way.
Well, my view is that I do think many markets are strongly overvalued. I'm not sure it's because the sustainability risks are hardly priced in, although I think if they were priced in, that would lead to certainly an adjustment in valuation. I also do believe that there are great opportunities for people who follow this stuff. I mean, think about it this way. All of this is just a proxy for finding a well-managed company, right? You want to invest in a company in some industry and you want to figure out which company is best. Do you pick the one that has a great management team, strong governance, really good underlying fundamentals, and they are attentive to the risks that could derail their future returns? Or do you pick the company that is all those things but is oblivious to some of these off-balance sheet risks? And that's kind of all this is, right? And so I think, if you can find ways to use data thoughtfully and find these kinds of opportunities, I think it is a great opportunity for investors. Yeah.
Okay, thank you. That's an interesting comment. I quite like that. I think lines are beginning to blur between ESG and impact, which are distinct. But I think this is a good thing, stronger together. We also had a point about Africa earlier. I don't know if any of the people who joined the show earlier from Africa are still watching, but if they are, it'd be lovely to get your comments on that. Bill, irrational pessimism. So is there irrational pessimism at the moment, do you think?
No, I don't think anything's irrational right now. Like it's a hard question to answer because we're doubling down on all of this. We have an actively managed U.S. large cap strategy. We've added a passively managed fossil-free strategy that is also verified carbon neutral, and then we're in the middle of launching a ESG fossil-free covered call strategy. So we think that there is tremendous upside in this space, but I think a lot of ESG has been kind of plain vanilla product. And so just like in every other kind of like corner of financial services, I think there is a need to be thinking about product innovation and creating products that kind of meet the needs of investors. Right now, one of the needs of investors is income. So we're launching a product that delivers income. So we are incredibly enthusiastic about the future, but I do understand why there is pessimism, and I also understand why there's exuberance. It's hard to know whether it's irrational or not.
Okay, we are really coming to the end now, and I thought this was quite an interesting question. Curious to know if the panelists are finding that companies included in a fund are able to clearly articulate their impact. Any struggle with getting the impact reporting aligned with impact thesis? Any thoughts about that question? Quite a tough question, I think. Thank you, Dawn.
So again, I approach it from the fixed income perspective, but this is something that we've worked on for years to increase the transparency and impact reporting. Now, our strategy, the use of proceeds. So where we have become more involved as bondholders is in engagement, whereas in the past that really wasn't really a thing for bondholders compared to equity holders or stockholders. So, but that is something that we are very active in. We're actually starting a working group with ICCR, which is a coalition in the United States for faith-based investors, working with them on an engagement for bondholders. And I think that this is something, we'll continue to see, that the transparency, the reporting, are they producing the reports that they said they're going to produce with the impact metrics and considerations? And if they're not, why not? And how can we help lead that along? And then just being a more vocal voice in this for transparency purposes.
Okay, thank you. All right. So look, we really would be winding up now, really. But I haven't asked the question, what is the future of ESG investing, which is kind of the theme for today's show. So could I ask you to do a very, very quick answer to the question? Let's do some crystal ball gazing. What is the future of ESG investing? Can we do that question in less than 45 seconds each? Bill, can you have a go at that?
Yes, I'm going to return time to other people by saying simply that I think it's just the future of investing. I think, eventually we're going to get to the point where, and I think this is probably more true today in Europe than anywhere else, where it's just it's additional data points that are used through the lens of which people make investment decisions, and we can just kind of lose the terminology.
Okay, interesting. So in almost like saying, what's the future of electricity investing? Electricity isn't everything. You don't invest in electricity. Electricity is what enables things. Maybe it's a similar analogy there. Chris, what are your thoughts? Future of ESG investing?
Yeah, well, when we founded ESG Investor, our strapline was investing in the future, because we for two reasons. Because we believe that effectively all investing sooner or later will be ESG investing, and also it's about building the future that we want to see, the future that we want to live in, and that's allocating positively to the kind of companies, the projects and assets that are going to kind of build a future that we can all thrive in.
Okay, and Elisa?
I would just say let's reduce all the noise around the labeling, what it's called, and just focus on what it is. And what it is, and I'll echo Bill, it's the future of investing. It's the current state of investing, and it's the future also. So I think it's very bright.
Well, I like that as an ending for today's show. The future of ESG is the future of investing, or the other way around. The future of investing is ESG. I think that's a really nice way to finish today's show. And thank you very much, everybody. And for everybody watching, April the 9th, watch out for more news about that. And see you soon. Thank you. Bye.
Thank you.
Thank you.
Bye-bye.